Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, y'all. We got an awesome show today. Today, we're joined by Keith McCullough. Keith is the founder, CEO of Hedgeye, premier online financial media company, provides real-time investing research. Also, he's been joining the ETF Terror Dome. We'll get to that later. Prior to founding Hedgeye Risk Management 2008. Interesting timing. Keith worked from several big-name hedge funds. Y'all know. Keith, welcome to the show.
Thanks for having me. It's good to see you in the in your domain here. Like I got mine. I got the background of mine, but I'm in yours.
Yeah, well, last time we got to hang out here locally in Manhattan Beach down at Sloopy's, and you're East Coast guy. Where do we find you today?
Stamford, Connecticut. So, yeah, a little less exciting.
2008, man, what a time to start a business. You know, we often tell people are always talking about market crisis, and I say some of the best companies in history are started in the down times. You know, I moved to San Francisco in like '01, so got to experience the internet decimation, obviously lived through the '08, '09. What gave you the bright/naive idea to be an entrepreneur in the middle of a financial crisis, man?
First was necessity. I mean, I got fired in October of '07, so that was kind of a problem. So typically these things happen from a spot. I mean, I always say it was a blessing. I'd highly encourage anybody who hasn't been fired to get fired because it opens your eyes to a lot of different possibilities. In my case, it's like, look, I'm never going to work for somebody else again. So that was an easy decision. Was I going to go start another hedge fund because I'd sold mine in '06? Then I went to Carlisle after that, or not. I mean, it was really an open question, Meb. Like I wasn't quite sure, and still some days I'm still not quite sure what Hedgeye is going to be. I think you have to keep an open mind to the game that you're in, and as it's evolving, how does your company evolve and change? And I was quite fortunate to have a lot of, big railway tracks, like Twitter and YouTube, a lot of different power alleys that I could take, bring content to life and bring. If you look inside of a hedge fund, that's what Hedgeye is. What would you see? That was the idea. And just run my book out loud so people could see all my positions, et cetera, et cetera. And we're still doing that today. But yeah, it's been a long run. It still feels like a startup though. It's 18 years in.
This is first time on the show. And so I want to give the listeners a little background because you approach markets, I feel like in my mind, it's somewhat traditional. In other ways, it's very non-traditional. So let's hear a little bit about the framework. I know of the word cloud, we're probably going to say quad more than any other word today, but talk to us a little bit about how you think about markets, and then we'll kind of jump into where we are today and everything else going on in the world.
Yeah, the two words that would appear most frequently in the word cloud would be signal and quad, right? So what is signal? Signal is my fundamental belief that the market is going to always be more right than I could ever be. I never start with what the world could or should or would be. I start with what the world is, as defined by fractal signals that I built. So they're multi-duration, multi-factor. Not that everyone wants to get into what all that means, but they're quite different than typical, like what I affectionately call kind of like old wall technicals or whatever, things that I used to use. And some people get upset when I talk about that, but they shouldn't be, because I'm making fun of my former self. I mean, if they work better, I would use them, obviously, right? So, I spent a lot of time on this. I've spent a lot of time on everything from fractal math and how it explains markets much better than what I used to use, than a lot of other things. So it's signal to quad. And what is the quad? The quad is the economic outlook. So the market's very good, and in particular, the modern day machine and front running big causal factors like, what is the rate of change of real GDP growth? What is the rate of change of inflation year over year? Those are two of the better back tests. So if you could be from the future and your signal is predicting the future, you would be, right? So that's where I try to live in not so much trying to tell the world where it's going to be in a year or two or three, because I'm really bad at that. It's in really getting that, call it, immediate term trade, as I call it, 3 weeks or less, to intermediate term trend signal right, because that can get me to like quarterly investing, which would be 3 months or more. And my sweet spot's really in that 3 month to 9 month, maybe 12 window. If I get to 12 months, I'll get less accurate. The further out in time I go, I tend to be worse. So that's, just generally speaking, it's signal to quad. A lot of people who get to know the process come to realize that if I only had one thing, I'd actually go with the signal because there's a lot of noise. And we also do it, it's global macro, right? So I do all asset classes. I do 50 different countries, the quads being, 4 different economic scenarios with growth and inflation being the 2 rate of change factors. What are those things doing? Each combination has a different quad. So quad 4 is the worst. That's where growth and inflation are slowing. Quad 2 is the best. We're currently, heading towards our process would say where both growth and inflation and therefore profits are accelerating. So what we try to do is front run that because the behavior, if that ends up being the future of markets, is predictable.
Yeah. You guys have a great post we'll link to in the show notes, listeners, called Starter Guide to Full Cycle Investing. This is maybe 5 years ago at this point, 6 years ago. There's a beautiful chart talking about our risk management overlay. And maybe let's double click a little bit more on kind of the 4 quads. And you could give us like a little bit of, say, here's where we're broadly now. I think everyone obviously most familiar with the US, but also we could delve into kind of the cool part is you don't just talk about U.S. stocks and bonds. You're talking about just about every asset under the sun, but maybe give us a little more on the quad so people can kind of really get a good understanding what this framework is.
The number one country model that affects all asset classes is indeed the U.S. model, right? So if I want to get, like we've just recently gone from long to short Germany, for example. I mean, the German model is obviously different because it's Germany, right? Germany is a different place, it has different factors in the model, et cetera. But on the US model, when you dig in, like currently we're in, September in particular, because we do monthly quads and quarterly quads. The machine being the overall market system, algos, AI. I think that actually we've never been this accurate. And I think there's no irony in that. It's because the machine is smarter because machines and computing power get to the answer faster. It's not unlike, watching Bitcoin. That's the game. If you can't compute faster, you lose the game. So I do think that the machine's getting closer to the pin, if you will, like in calculating these things. So if you take September, and you take quad 3. Quad 3 is when you have stagflation, right? You have the rate of change of real growth starts to slow and inflation's ticking up. That is causal in making real world growth slow because human beings have less purchasing power. So something like gold back tests better than anything that ticks in major macro, like asset allocations in quad 3. Gold likes quad 3 and it likes quad 4. What do quad 3 and quad 4 have in common? Growth slowing, okay? But when you have growth slowing with inflation accelerating, that actually, like I don't need to write white papers on why I'm long gold right now. It's because of quad 3, right? It signals higher all-time highs in quad 3. It's very typical to the 2011 stagflation. And they're very similar to that, but nothing's ever the same. So, again, what is happening? Labor data is slowing. So the Fed has an open window to go cut interest rates, dollar down, rates down, gold up, quad 3. So again, that's why I try to find fractal patterns that are, the whole point about a fractal pattern is it's self-perpetuating. Similar sets like rates, gold, and dollars are doing the same thing, and it's reinforcing. And it also saves us a lot of time. Like you and I, yeah, it feels like startup still, but it's like I'm an old dog now. I'm 50 years old in this game. That's not young. I prefer to have a shortcut. I prefer to say, that position's working because of quad 3, or the stock market blow up that our process called this year was into a quad 4. Quad 4 is when shit hits the fan. Everything essentially that everyone owns, large cap growth in particular, goes straight down. That was February to April. That was a quad 4. So you didn't have to have a recession in quad 4. That's when people started calling for a recession. That's a different thing that's set up for the kind of rally that we've had. But you don't have to boil the ocean, man. Like you and I have written a lot. I think you and I probably just as soon as not write anything on why. I mean, it's like, when do we get into these asset allocations? When do we get out of these asset allocations? That, for me, at this stage of the game, is the primary thing that I care about. When do I get out of this quad portfolio that I'm currently in?
And how often do these change? So is there a scenario, like, is it tend to bounce around the quads, like monthly, quarterly? Could you have a full year where something is just one quad? Or like, what's the kind of turnover being the wrong word, but how often do those signals switch?
Yeah, turnover for some people is a bad word because they don't like the move. I love turnover because every day that's all I do is move. And that's why I call it the full investing cycle process. If you could be on the right side of a sine curve, like in a sine curve, you're either accelerating or you're decelerating. That's why I don't say I like it because I like this short because it's expensive, or I like this long because it's cheap. I like cheap longs, yeah, but I prefer that the growth is accelerating with those longs. So now I have growth at a reasonable price. Okay, great. But again, what we're really talking about is how long do you accelerate? And that typically doesn't run further than 4 quarters in a row, and a decel doesn't either. And that's actually why a lot of country exposures flip. Like that's why Germany, for example, is going from a long because Europe had an actual economic acceleration because they had a recession behind it in 2022 that they accelerated from. So now Germany in 2026 is going to decelerate potentially into a recession again. They're just called base effects, which you're well aware of. We can get into that. That's how we start the calculation, is what is the prior. So in any Bayesian calculation, as you would know, because you're a quant, you basically take, okay, what is the prior? Now I'm taking real-time predictive tracking algos, lock that data on top of the base effect, and then that gives me my forward outlook. So that typically will be four quarters of acceleration or deceleration. If you get like a really bad situation politically, like Argentina or Brazil, you can have like 8 quarters of quad 4 or quad 3, right? Like, because you devalue your currency, you get stagflation, and it doesn't stop until the currency stops going down. Like, I mean, there are different countries. EM in particular can be in a bad quad for quite some time. Or the US, like if you go back to the 1980s, could be in quad 1 for like 3 years. I mean, that would be great. The problem, which you're not asking about, is when people ask about turnover, they want to have low turnover, I think. But the fact of the matter is that the world doesn't care about turnover rules or what you would like. It's going to do what it's doing.
And also the problem with so many investors, they have a position, particularly when it's working, and the signal changes. And how many times have you heard someone that just doesn't want to or doesn't take the signal, right? They're like, and I remember having this feeling talking about trend following research back in 2007 and seeing REITs roll over and having that feeling is like, it's like leaving a party, like not wanting the party to be over, or having this amazing weekend, wake surfing with your friends, whatever it may be. And just that feeling is like, I want to bottle this. I don't want it to end. And it feels the same way. Like you see some of these signals, you're like, okay, well, and listeners, I want you to think about this, all of y'all, where you see the signal and you're like, you know what? I'm just not going to take this one, right? I'm just going to skip this one. And then invariably, that's the one that just haymakers you. But yeah, I feel like a lot of people turn over, particularly when it's something that's going in their direction, they really don't want to take that signal.
I think a lot of it has to do with alternatives too. I mean, like the reason why I think you and I got along fairly quickly, and it's not obvious to people I don't get along with everybody. I mean, but it's because I just do it differently. And sometimes people that do it differently can't get along with people who can't think differently. I mean, but you and I have one thing that's very much in common, which is we can go anywhere with our hard-earned capital. We can allocate to any strategy anywhere. When you have a hard time getting out of something, it's like somebody who can't just actually get to the finish line and go through a divorce. It's like, because you really can't just see yourself in a situation that's different. These aren't relationships. They're tickers, man. And if I can go anywhere in the world, 50 different countries, 5 major asset classes, there's always a place to get into a new relationship. And again, I'm very promiscuous with this strategy, and I like to be, because it's a way that's not natural for people to think as human beings, but it's a better way to compound returns over time, because bag holding, which is another way of saying which you won't let go or leave the party, that's the best way to lose ground against somebody who's compounding off higher lows as the full investing cycles turn into different markets.
This is my favorite quote of the last couple of years. Adam Grant has a quote where he says, "The hallmark of an open mind is not letting your ideas become your identity." And how many investors do we know that says, no, I'm a Bitcoiner, I'm a gold bug, I'm a dividend guy, I'm a blah, 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 whatever, a value gal. And then, as we all know, those things those things can go not just a month or two, a year or two, or even a decade or two, not doing that great. So I think it can be dangerous.
And the whole business is designed to sell you that, right? Like, I'm 50 years old. I need a full body scan. I get that all you do is like ears and toes, but my ears and toes are fine. You're a value guy. I don't care right now. When I need your ears and toes, I'll come see you. But I think that Wall Street has always had that gravitational push away from where we start, which is I start every day with where's my family's hard-earned capital. That's it. You got to earn every ounce of respect. I define that per basis point of my capital every day to have an allocation of my hard-earned capital. And there are over 3,000 ETFs that I can invest in right now with no transaction cost. So giddy up. And the game has changed big time for people that look at the world our way.
One of the things you talk a lot about, and as often as a starting point, which I think most people only think about, and including investors, only think of as sort of the exhaust or after the fact, is the US dollar and currencies in general. Maybe talk to us a little bit about why that's important to you guys and how you think about it in your framework too.
If you backtest all of market history, the number one macro factor exposure that you would want to get right across asset classes would be the rate of change of the US dollar index. So again, at some point, maybe that'll change. A lot of people write about how that should or could or would change. But for now, given how many of the world's commodities trade in dollars and how many dollars have impacted that backtest, again, backtests are what's happened historically. I get that. But really I always say, if you get the dollar right, you're going to get a lot of other things right. If you were to lock me in a dark room with only one quote and I had to make money off that, I'd go with the dollar. And if you just think about it, I mean, right now, you got a bunch of macro tourists who are chasing the gold chart. We've been long for gold for a long time, but we got really long gold when the dollar broke trend in February and March. That was an explicit signal that the Fed was going to turn tail eventually, that the administration, whether they're Republican or Democrat, they only have one go-to move during a stock market crash, which is to cut interest rates and devalue the dollar, right? You know what to do with that. I mean, because history says you buy gold. And now 180 days later, it's got a 0.95 inverse correlation, right? So like the S&P 500 on an immediate term trade correlation, people are, what's the Fed going to do today? Well, who cares? I mean, it's what the dollar does today because there's like a 90% 30-day correlation between the S&P and the dollar. So whatever duration you're looking at, and again, correlations trend, they break apart, they find new ones. But, that is the number one thing to get right. That's why every Monday when I review, like I call Macro Monday in my early look strategy note, I review all markets within the context of what is trending up or down, where is the cycle. But I always start with the currency market because it's the most causal factor when you link it back to pending monetary policy, front running the Fed, et cetera, et cetera.
Yeah, and currencies can be a confusing topic for investors. They can have a pretty big impact, but some of the moves can go on for a long time. And some of these regimes and currencies can last for many years. And we've been in one of those for a long time, really probably until this year. So hopefully y'all got your travel in, US investors, because it's getting a little more expensive to go a bunch of places. Talk to us about the way the world looks today. You mentioned you guys have been positive on gold. And I assume that means the miners too, maybe for a little while. What else looks good? What looks bad?
For me, it's what's changing, what looked good that is about to look bad. The most obvious thing, because I like to start with risk management, not like, thanks for coming out. Everybody's long gold now. I mean, it's like now the question is, do bond yields and the dollar stop going down? Is the Fed going to have to deal with what we're now casting, which is a reacceleration in inflation in the next 3 months? If they are indeed data dependent, which, we could have a debate about that, I'd say that it's a good 50-50 coin toss because there's epic political pressure. But like when you look at the big ones, like where do I get out? I think that that's a big thing on Wall Street. Like anybody can sell you any financial product. I mean, that's Wall Street, right? I'm either trying to sell you stock if I'm a corporate, or I'm trying to sell you some bullshit brokered banked service. What I'm trying to do is get you out so that you don't have a drawdown, right? Like Europe is number one. Europe has been a huge run for us, however you want to define it. It has everyone chasing it now, from momentum guys to value guys trying to justify the valuation that isn't cheap as it was. Like my biggest winner was actually long Poland, EPOL, the ETF.
You and I actually talked about this at lunch a long time ago. Poland is up near darn what, 50 this year, 60, 70? I don't even know at this point.
And it's finally breaking down on my signal. But most importantly, it's about to run into the quads. The signal is front running a slowdown. Those kinds of setups, even though it's obscure to many people, it shouldn't be. Last I checked, I mean, when I execute on ePol in my PA, which it's not like a tiny PA, it's not George Soros's PA, but there's no like, we don't move the market. You can get in and out of ePol like in 2 seconds. These things are absolutely doable, right? So when you think about it, like the best levered way to play long Europe was actually Poland because it was the closest to the incursion of war. So not only did you get a reacceleration in economic growth in Europe broadly, but you had the geopolitical rate of change turned down. So you get the double whammy. And that is part of the growth out. If you have less war, you have a growth recovery. So now, like the Poland's, all the EM that is Europe and broad Europe, the majors, Germany being the most obvious one, are heading into what we call quad 3 stagflation on more protracted basis. So the thing about Europe that people sometimes forget if they're long it now, because they wouldn't have a memory because they've never been long it. A lot of people never were long Europe. And now you see tons of people talking about being long Europe. Well, that's great, but it's still Europe. They still have absolute demographic headwinds. If you think that we have a deficit problem, go to France. I mean, there are plenty of issues top down that I can tell you will suppress European growth. But my nowcasts have it ticking down starting in the first half, whereas the USA, we have what we call divergence, obviously, is USA's going into quad 1 by the first half of the year. And this has happened many times in history where you get that setup where the US is reaccelerating and the Europeans slow into a recession. So I'd say that that's the hottest spot, like in terms of risk that's pending, former longs that are becoming shorts. And I say that there are certain EM positions that we've had that look like that too, like Argentina, huge winner on the long side that is now a great short. So instead of quad 1s, 4 straight, they have 4 straight quad 4s. Quad 4 is bad. And a lot of macro guys that get caught off sides by these, they always get caught offside by quad 4. And I've had plenty of hate rain down on my inbox, like, who's this guy, blah, 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 blah. Because you have a lot of discretionary macro guys that are long, like, talk about bag holding something. Uranium would be at the top of the list sometimes, and Argentina, for whatever reason, is up there too. It's like, oh, because there's this whole political narrative, obviously, with Milei. But we're indifferent, right? It's just the process, right? Like, get out of Argentina and then short it.
Is there a price element to the get out part, or is it purely fundamental economic? Like, how do you think about that in terms of the portfolio? Is it like, as long as it's signaling green, you're good? Or is there any sort of, do you guys think in terms of stop losses? Like, how do you think about the positions themselves?
I don't give away my calculation, but when I say multi-factor, the 3 biggest factors in my calculation, and it's all rate of change in terms of how it's driven. The rate of change of the price, like most chartists will use that, right? That's what a moving average is. Again, rate of change of the price, rate of change of the volume, and the rate of change of the volatility of the volatility. It's that third piece that knocks the volume up and the pattern. Again, when you build a machine to look for patterns, that's not a pattern that you learned on Yahoo Finance, right? It's a pattern that I've around with like a lot of my life to get right, right? And so what you're really looking for, because Ray Dalio taught the world this, or at least taught me this, which I'm not afraid to admit who's taught me things, obviously. But, like in macro, if you can tell me what the trending volatility of the asset class is, I'll tell you what the flows are. If I could show a volatility breakout in an asset class, I'll show you a falling asset price. I'll show you negative flows. So what we're really doing with our process is trying to front run those flows with that constant analysis of volatility relative to the volume and the price action. If Argentina, which it did have 4 quad 4s pending, didn't break on what I call my trend signal, the intermediate term trend signal, I wouldn't have shorted it. So as a younger man, I would have, because I didn't know what I was doing, right? But now, now I have my fractal gods. So I can, they let me know when it's okay. And when it's okay, then I short it. And that's how we got out of Argentina and now onto the short side of it.
In terms of thinking of the quads, I've heard you also talk about sort of path, like the going from a certain progression of quads. Is there a certain progression of quads that you think are better versus others?
Yes, I mean, so we've, if I could show you this, like we basically back tested every permutation of the quads, including there's a difference between a shallow quad 4 and a deep quad 4. Yeah, deep quad 4 means that the growth rate is slowing faster. Shallow is like, yeah, it's slowed a little bit. We'll see if the market cares. And if it's only a 1 month of a quad 4, that matters a hell of a lot less than 3. So inside the quad, everything's been back tested. The what you asked, which is I think a great question that I infrequently get asked, is like, what are the best quad counts, right? So quad count being like, just like hopefully if you play blackjack like I do, you count cards until they kick you up, and like you count the cards, like duh. I mean, if you're allowed to, and if they don't know that you're doing it, keep doing it. So we're counting the next 3 quarters. The best quad counts are those that actually progress, like the one that the USA has currently, which goes from, we could be entering a recession, quad 4, quad 3, and then to quad 2 and quad 1. And that's really, if you think about what happened in the US this year, it's exactly what happened. Quad 4 hit the fan, stock market crashed. 94% on Polymarket, I think, or something very high, was predicting a recession at the end of April, right? The probability of a recession, I put it a 0% today, right? Of it being like at least now until the end of the year where we have line of sight. You actually get the positioning on your side because as a contrarian now, you're long the market that the street's short. And if you look at the Russell 2000, for example, which is the best thing to be long in U.S. equities by the time you hit a quad 1, and the only time U.S. small cap value outperforms large cap is in quad 1. So if I'm going 3, 2, 1, that's why I added small cap like a month and a half ago or whenever I did. And I hadn't been long it since the end of 2021. So again, because I didn't have a 3, 2, 1 quad count. And hopefully that answers your question. But you can do that for any country, obviously. And we show these quads at the clients every day if they need them.
I was laughing as you're talking about Polymarket because I love watching the prediction markets. But, sometimes they're a little nutty, including I was laughing earlier this year. There was one said, will Jesus Christ return in 2025? And I think that was up to like a 4% chance. And I said, it seems like pretty easy money on this one. I don't know. Anyway,
they always give it a 4% for some reason. I'm a big fan of JC. I got a lot of country songs where they have them coming back, but I wouldn't bet on it.
I wouldn't bet on it.
Polymarket, by the way, that's for us, the TBD. We're about to launch I think there's a tremendous amount of money to be made in Polymarket if you have a good macro process, because they get like today. If you're going to have today, no matter what's happening today, actually, while we're talking, the Fed's going to illuminate the world on what the bond market and the currency market has been pricing in for months. But, great. Thanks for coming up. But the real money to be made is as soon as that rate cut hits, you go out to the December Polymarket odds of a December rate cut, which will probably peak. And that's when you place the bet. Like, we're running that money prop now. I'm not actually allowed to create an ETF for that. I tried, but I'm sure you can imagine the legality just because of Polymarket. But this is where the world's going, man. Like, this is a great new frontier. You talk about me, I'll trade anything that's not locked down. I mean, that to me is a really good opportunity.
I want to get into y'all's forays into asset management in a second. I'm going to ask one more question, though, while we're on assets in the world. One of the major asset classes that we haven't really covered today yet is sort of fixed income. And fixed income, there's a lot of different types of fixed income. There's obviously U.S. Treasuries, there's corporates, there's junk and emerging, yada, yada. How do you guys kind of think about fixed income and kind of where we are here at the end of September? Is it interesting, not interesting, dangerous, exciting?
Yeah, I mean, the high yield positions, the higher the yield, the better we've done. I mean, no recession. If you made that bet, by the way, back to the Polymarket example in May, you tunned it, right? No recession. That you paid out huge. But what you really should have done as an institutional manager was if you didn't believe in a U.S. recession, you shouldn't have believed in a further widening of credit spreads, right? So you should have stopped believing in an inversion of the yield curve and a steepening of the yield curve. So two of the bigger positions that I have that, again, I publish my long only portfolio, like my family's long only account every day. I'm dumb enough to do that. But I mean, the CLOZ, which is Eldred's CLO ETF, it's got an 8.5% yield. The thing's just awesome. And the only time you're going to not be awesome there is when you hit a quad 4 and have a process for that. That's when credit spreads widen. And the other one would be iVol, which is Nancy Davis at Quadratic has, sometimes I have to sell her on how good of a steepener product it is because she doesn't call it a steepener, but I think she should. But the yield curve could steepen in my scenario materially. Why would the yield curve steepen? So again, yes, we're long LQD, investment grade credit. Okay, we're long. To me, that's boring. The two positions that are more interesting are the two that I just mentioned, I think. Now, IVOL, if you look at the 10s -2 spread, it's about 50 basis points wide. That could be a five bagger. That could be 250 basis points wide. How does the yield curve steepen from here? Well, the whole debate's about how many rate cuts. There's no rate hike coming with Pump replacing Powell with whoever. There's either going to be rate cuts or there's going to be nothing, right? So you keep the short end is going to be anchored at some level. And if U.S. growth does what I think it's going to do, which is actually reaccelerate, the long end of the curve is going to trade with that and bond yields are going to start to go up again. So it's also a nice hedge for gold because I'm long too much gold right now. And that would be the thing that I need to get out of next. Because again, a breakout in interest rates would be down gold, but I'd be getting paid on that piece of fixed income. I try to always have, like in the book, in the long only, even though it's harder for me to make money in the long only than my long short book, because I'm trained as a long short manager, but the long only book's got to have that kind of asymmetry. Like you can't have like most retail investors. And yes, I think that's an insult. I mean, I think if you're a full cycle self-directed investor, that's a compliment. If you're just YOLO weekly call options with 5 positions, that's not a portfolio. But if you're trying to do what I do, you have over 20 macro positions. I mean, there should be things that work when the other thing isn't working in the portfolio. So those types of fixed income positions, I think, are quite good portfolio positions right now.
How do you guys think about position sizing? I feel like I could go on for about 2 more hours talking about some of these things. I want to reserve some room because I know we got a tight schedule, but do you equal weight all these? Is there a manner in how you think about, a certain chunk to each of these positions?
Yeah, I mean, you and I we should actually do a full blown webinar to educate people on, because this is like the number one thing that your local homer or home gamer or retail investor up. They don't have discipline or rules for portfolio sizing. Okay, so every asset class, we beta adjust each asset class or volatility adjust the asset class because that's how my process works. So my max position in a fixed income position would be a 10% position in something like CLOZ. My max position is 6%. I'm definitely not the smartest investor, but I am one of the more consistent and disciplined investors, and I prefer to be the latter because I don't have much of a choice on the former.
Going back and researching a lot of the old commodity trading advisors, macro hedge funds from back in the olden days, 70s and 80s and 90s, it's great because a lot of those really talked in terms of position sizing, risk management, and volatility adjusting. And so I remember talking to a buddy of mine, billionaire, and just to illustrate this topic of what we're talking about, he was giving a presentation. He was talking about how this is years ago, but like hugely bullish gold, and talking about how he's just like putting on a massive position. He's very bullish. And then asked him, I said, well, like, what does that mean as a part of your portfolio? But for him in his mind, it was like going from like 2 to 4%. And your average, you said homer, but your average person, when they hit, oh my God, bullish, I got to be like half in. I talked to so many, particularly on the younger side, the crypto people, they want to hear either it's like, I'm all in 100% of my money or even more, like YOLOing double, triple exposure, or it's zero. And so I'm thinking in terms of position sizing, to me, is one of the most important parts of all of this. And I think the easiest one to get wrong, people take on way, way too much volatility and exposure on just a few assets.
If you're young or you're older, it's not age driven. If you're older and you're living like in a van down by the river and you need the thing to triple to get out of the van, I get it, right? These people are all over Twitter. They're all over you and I. That's different. I mean, our process is built for, again, rule number 1, don't lose money. That doesn't mean like it's just a stay rich plan only for rich people. It means rule number 1, which last I checked, Buffett and Munger's rule number 1 used to be, at least when they were talking about building a real business, don't lose money. And rule number 2, compound returns on that money. So the best way to do that is to not have like some wackadoo volatility structure to your portfolio, because that's not really a portfolio.
It reminds me of the old Ned Davis book, the title, which I thought was great, Being Right or Making Money. And we'll put this in the show notes, listeners. I know you're a big reader, Keith, but we did half a dozen books, historical investing books. I said, here are some of my favorites that not being you, but just the audience have probably not read because they have less than 100 reviews on Amazon. And I don't even remember what they all are, but we'll put them in the show notes. But Ned's was one of them, including probably my single favorite investing book, Triumph of the Optimist. And how that only has less than 100 reviews, I'm not sure.
These things on books, like Munger and Buffett, I wrote my senior thesis at Yale on Buffett's strategy and how it would work with a short selling strategy. One of Munger's favorite books was by Herb Simon called Models of My Life. Nobody reads that book. You can't even buy that book. Look it up on Amazon. It's like in hardcover. You can't find the bloody thing.
Yeah, I don't know that one. I'll have to look it up.
People would prefer to read their Instagram. I mean, the average attention span of an adult in America today is 8 seconds. I mean, so readers like us have a significant advantage.
Yeah. All right. So you've been doing content for a long time. And by the way, where's the best way, the entree, if people are like, I don't know Keith, you have a large audience, but the people who are listening that you're new, you go to Hedgeye, what would be the entree sort of place to start following or reading what you're doing as far as the different products and services you guys do?
Yeah, I mean, the first thing, if you wanted to put in that, there's two different answers, like, because, you have lazy people and people want to put in the work. I mean, if you want to put in the work, and I'm not talking about like 25 years of work, I finally wrote a book that's less than 100 pages that's for free that you can download. Okay, it's called Master the Market. It doesn't mean that I've mastered the market. It means I'm trying to master my process. So it goes through the process with pictures and pages that should illustrate the quads, how I think about it. That would be like ground zero. Hedgeye University too is another, we make it all free, because I think education's the biggest gap between what you and I are just calling out, which is why would people not understand portfolio sizing? I mean, come on. So there's that. If you're of like the shorter term, like you want to start to get a feel for it. I mean, I'm up at 4:30 every morning. I'm one of the only people on Twitter, I think, creating content that is actionable between 4:30 and 6. I mean, I do that for free. Then I write an early look. So my whole process, Meb, I've tried to like monetize it. So, okay. After I've been sitting there for an hour and a half, and I've been noticing everything in every model that we have across, I have 100 people here that are working alongside me, pumping me with information, data scientists, software engineers, analysts, senior analysts, junior analysts.
100 people, my God, Keith, what are they all doing? That's a lot of folks, a lot of head count.
Yeah, they're content creators, so what are the top 3 things that I'm noticing that morning? Because, Mandelbrot, if you go back and like review what you said, which is old commodity traders, well, where did they get that? I mean, Mandelbrot was the first one to use the big blue machine from IBM in Yorktown Heights. And like, okay, it's most of market moves are Brownian motion. He was studying all commodity prices, right? So the misbehavior of
his
market.
book's over there somewhere. I don't see it, but it's on the shelf
it's
somewhere.
It's the yellow one right in the middle. It's like very easy to find. Okay. What I'm trying to do is show all the components of the process, right? So the macro shows my show, like at 9 o'clock pre-market. That's 30 minutes. Is pretty popular. People do that, or I have real-time alerts intraday. Kind of gets me painted as a shorter-term guy. I don't care. And then we have, of course, ETF Pro, which has all the positions, including, I own 2 of your ETFs that I just mentioned, a global value one and a cannabis one. So ETF Pro is I think that's probably the cheapest, the biggest bang for the buck product. But if you really want to learn the process, read the book, engage with the content, challenge yourself on what you think. A lot of the things that I make fun of, I think I'm misunderstood on it in the sense that I'm really making fun of my former self, because I used a 50-day moving monkey. My bosses used a 250-day moving monkey. One really clever moving monkey used a 10-day moving monkey. There's so much bull that we get taught that I can only make fun of my former self. So I think in that too, my process is for somebody who's trying to evolve and learn and can be challenged and can be coached. It's not for somebody who's just trying to be backslapped by the cabal of mainstream CNBC type media.
Well, look, that's the whole point, right? Growing and learning. I mean, I say this often on Twitter. I mean, almost never, really never, do you see someone who's been through a number of market cycles that claims they've got it all figured out. I mean, there's a few on Twitter, of course, but most of us that have been through this, particularly in the macro world, humility is like my number one thing that I would consider and allocating to someone, because we all know that it's a whole process. I want to save a couple minutes. Keith, we got to talk about, you guys have started a foray into the ETF Terror Dome. Congratulations. Welcome.
Why do you call it the Terror Dome?
Because this is a quote from our buddy Eric Balkunas at Bloomberg, because, there's so much competition. There's so many firms, so many funds. The good news is the good ones and last and survive over time, we think. And a lot of the kind of ones that are, what's the right word? Predatory, poorly designed, eventually will go by the wayside. So that's a Balkunas quote. Anyway, tell us a little bit about your concept behind launching Hedgeye Asset Management. What are you guys up to? What's your plans?
Well, first, Balkunas hasn't shown us any love on it yet, so I'm looking forward to maybe something like that. Because what you want is somebody to actually look at the performance of the products, right? Back to the point on there are different kinds of people that are going to consume Hedgeye's content. If you're not willing to do all the work, well, I'll just put it in ETFs now. I'm like, everyone can see the impact that I have on telling people to buy other people's ETFs. Yesterday, I added back Mike Taylor's Pink ETF, which is the top performing healthcare ETF on a 3-year look back. It's just bar none the best performer. I know him. I know his process. It was trading 20,000 shares a day. It traded 500,000 shares. Okay. I didn't get a cup of coffee today for free from the Simplify, sales team. There was a point where I'm just like, okay.
But also there's a large part of the world, that it wants that. It's just kind of like the do it for me crowd that I bought into your methodology. I like how you think. Can you just package this up in a way and I'll ride along with you? And I think that's a good thing.
No, it's a very good thing. I think the next frontier is, well, first of all, if you take a big category like the first one I went after, which are hedged S&P products or buffers. This is why Balkunas and others should be as critical as they are of the absolute, steaming hot pile of out there in ETF space. I'm like, okay, those aren't hedges. Let's create a real one, right? The one I use every day. The rules on this stuff. I'm not allowed to even, you know what the ticker is.
You can talk about them all you want on my podcast. We got a quality growth, HGRO. We got a capital allocation, HECA. We got one partner with our good friends at Crane Shares, KSPY. Was that the first one out?
Yeah, that's KSPY. So KSPY, you can look at the performance against JP Morgan's hedged, it's 20 billion plus product. Performance speaks for itself. I don't have to talk about performance, but what I really want to do is I want to get into place like Hedgeye should be pretty good at hedge strategies, I would say. We're the only firm that's called every market crash since '08. When I say people are cringing because they didn't, that's pretty much the only thing I could say about myself that's good. So it's a thing. So, and we don't have any competition as far as I can see, that's legit there. If we can't compete with it, I'll put it in the portfolio for the family if Meb can create it, right? I think the future is going to be a curation of this landslide of capacity or oversupply of ETFs, just like it was for stocks. How could you, on the one hand, not understand that you could coagulate the S&P's return into 7 stocks, but not understand that you can't build, a portfolio of 20 to 30 ETFs out of 3,000? And some are going to be mine, and some are going to be yours, and some are going to be other things, right? So that's how I think about it. I think I'm on the right track with that because it's a lower fee way to create a return profile that you'd like without the drawdowns.
And what's the vision? Are you guys planning on putting out 3, 6, 12, sort of see how it goes after a year or two?
My problem is I could put out 1,200 or just make up a number. But each one has a cost of capital. So, and I refuse to give up any of the equity I always have with Hedgeye because I'm a selfish capitalist and I like my dividends, our own internal distribution, right? So it's interesting. It'll be, I don't know what your thoughts are on this, but what it costs to create your own ETF. It's never been lower. It's not an inconsequential number, right? But it's consequential enough that makes me space it out. I could have the equivalent of case buy for gold, Bitcoin, long-term, everything that I have a risk range on, which every day I publish 30 of these things. So when I say I could do 1,200, I'm joking, but I could easily do 100 ETFs and compete with a lot of different people that wouldn't want to be competing with them.
And tell us a little bit about how the strategy works on hedging. What does that mean? How do you think about it? What does it do?
Well, if you think about like, just you're either a chaser or you're a fader, right? When you think about like your primary stance as a risk manager, i.e. a trader, I'm a fader. Like, call me Darth Vader. I don't care what you want to call me, but that's what I do, right? God forbid, I buy low and I sell high. Now, if you create, like which we've created, our algo is selling calls at the top end of the S&P's published risk range, at a very basic level, and doing the opposite at the low end of the range, right? So instead of having a quarterly collar or hedge or whatever the hell people call being hedged, ours is dynamic, daily, can be episodic, doesn't have to transact daily. It only transacts when it's at the levels that you've calculated as consequential to act. So that's why it works. I mean, I've used it my whole career. Really, it's probably one of the most important things that I use when I make a decision on U.S. equity beta throughout the day. Where are you in the risk range, right? I mean, you just made 9 straight NASDAQ all-time closing highs. I mean, the Fed could say nothing today and it could be down 2% just because it went up back at the low end of the range, which is like 2% below the market. So I think they're pretty straightforward concepts. The whole thing is to educate people on how you're utilizing them.
This is going to be a hard question for you, but we've been asking this the last couple of years. What is Keith's non-consensus belief? So you sit down at a table of pros, you guys go out to a lunch, dinner, and you say something out loud. It could be a market belief, a thought about just philosophy on markets and investing, and majority of your peers will shake their head and say, that Keith, he's a numbskull. He doesn't know what he's talking about. Is there any sort of belief or view that comes to mind?
Well, this one would be very easy for me to answer because I live like very close to Greenwich, Connecticut, and my office is Stamford, Connecticut. So if I were to sit in maybe that's why I don't get invited, but unless there are clients, like the idea dinner where you sit down and you say that, I would sit down in front of a bunch of my former selves, captain stock pickers that run hedge funds. And I would say, captain stock picker is dying. The flows trump anything you could think of fundamentally, and they will continue to do so. They won't like that.
I think that might be the most important, at least to me, comment of the entire podcast, where I was talking to somebody the other day, and it was up in Santa Barbara, hanging out with my buddy Steve Drobny, someone was talking about Bitcoin. I say, I don't care about what your views are. I'm like, if you just look at the flows into the ETFs, you at least take notice, right? Like the flows, we often say drive factors, right? Like flows to me is kind of the whole game. Anyway.
And they're easier if you have a process. I mean, that's the whole key, right? If you don't have a process, you don't believe it. If your whole process starts with stock picking, then you believe that. I mean, there's inherent bias in that distaste for the comment, but that's what I'd say.
What's been your most memorable investment? Good, bad, in between?
My worst short position was shorting Reebok before it got acquired by Adidas. So I was at one of these sell side events at Bandon Dunes. So I was on your time. And let's just say we had a good time the night before. A bunch of us, we were the clients, So here I am. It's back in the days of no cell phone, so my phone's ringing and I'm not waking up, and it's the firm's biggest short position, and or at least one of them. And finally, the front desk person came and woke me up. I've been yelled at plenty from the fans to the other team in my life, but I've never quite been yelled at like that by my boss, and that was the worst short position I ever had because I couldn't take it back.
Listeners, if you've never shorted or had the experience of shorting, I would highly suggest doing it and not with much money. Try it if you've never done it with like 0.01% of your net worth. But just the experience of being wrong-footed on a short ripper is the worst feeling in the world. It's far worse than a long going down in my book. It is just like the most gut-wrenching, emptying out, hollowing feeling in the world. Especially when you're at a beautiful golf course, which the listeners who don't golf don't know what Bandon Dunes is. But that's, oh man, what a rough way to be woken up.
Yeah, it's tough. That's tough.
Keith, this has been a blessing on a day that the S&P hit 6666. We'll definitely have to have you back. Hedgeye.com, the best place to go?
Yeah. And for Hedgeye Asset Management, it's hedgeyeam.com.
Beautiful. Keith, thanks so much for joining us today.
Thanks, man.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.